Hello and welcome back to another deep dive episode of MonsterInvest. I am your host, Daniel. Today, we are going to embark on a journey. We are going to deconstruct one of the most critical concepts in the history of investing. If you stick with me until the very end, this episode might just change the way you look at money forever. I want you to close your eyes for a second. Imagine you are building a house. You decide to construct it on a breathtaking cliffside overlooking the ocean. The view is spectacular. For 10 years, the sun shines, the breeze is gentle, and you feel like the king of the world. You built this house with massive glass windows to capture every inch of that view. You didn't worry too much about the foundation or the thickness of the walls because, well, the weather has always been perfect. But then the climate shifts. A hurricane rolls in. The wind begins to howl at speeds you've never experienced. Those beautiful glass windows. They shatter instantly. The foundation, built for sunny days, starts to crack under the pressure of the storm. You are left standing in the rubble, soaked and shivering, wondering what went wrong. This is exactly the reality for most investors. They construct their portfolios for the sunny days. They load up on the hottest tech stocks, the popular index funds, and perhaps a heavy dose of cryptocurrency, assuming that the market will always go up because, in their recent memory, it always has. They are what I call fair weather investors. But history tells us a different story. History teaches us that financial markets are not a calm, predictable ocean. They are a wild, untamed beast. We have periods of booming growth, yes, but we also endure crushing inflation, deflationary depressions, and stagnant decades where the stock market goes absolutely nowhere. So the question we are answering today is, how do you build a house, a portfolio, that can withstand a hurricane, a blizzard, a drought, and a heat wave all at the same time? How do you build a structure that survives every possible market condition? We are discussing the all-weather portfolio, but not the dusty old version you might find in a library. We are breaking down the all-weather portfolio 2.0, the modern fortress for your wealth. To truly understand this, we need to go back to the drawing board. We need to dissect the economic machine. You see, many people believe the market moves randomly. They think it fluctuates based on the morning news or a CEO's tweet. But fundamentally, asset prices are driven by just two primary forces, growth and inflation. Think of these two forces as the X and Y axes on a graph. When you cross them, you get four distinct quadrants. These are the four seasons of the economy. The first season is rising growth. This is the summer. Companies are selling more products, hiring more people, and profits are soaring. This is when the stock market booms. Everyone feels rich and optimism is high. Then we have falling growth. This is the winter. A recession hits. People lose jobs, spending freezes, and corporate profits collapse. Stocks typically get crushed in this environment. Next comes rising inflation. This is the scorching heat wave. The price of goods rises faster than wages. Your money buys less. Cash loses its purchasing power rapidly, and traditional bonds, which pay a fixed income, see their value evaporate. And finally, we face falling inflation or deflation. Prices drop, debts become harder to service. It's a dry, cold season where growth is scarce. Here is the problem. You, me, the smartest economists at the Federal Reserve, and the biggest hedge fund managers on Wall Street, none of us know which season is coming next. We might have a guess, but we are often wrong. Most investors, without realizing it, bet 90% of their money on just one season, rising growth with low inflation. They hold stocks and maybe some corporate bonds. If we get a recession or an inflation spike, their portfolio has no defense. They are betting on good weather, but they have no umbrella. Let me introduce you to two characters to illustrate this narrative. Let's follow the journey of Tom and Sarah. Tom is a successful dentist. He's smart, hardworking, and makes a significant income. But Tom suffers from a cognitive trap known as recency bias. He believes the future will look exactly like the recent past. Back in 2020 and 2021, Tom was having the time of his life. The government was printing money, interest rates were near zero, and tech stocks were going to the moon. Tom looked at his portfolio and saw it doubling every year. He felt invincible. He started thinking, why do I need bonds? They pay nothing. Why do I need gold? It's a useless rock. I'm going all in on innovation. Tom built a portfolio that was 100% aggressive equities. He was optimized for the summer. Then came 2022. The season changed violently. Inflation, which we hadn't seen in 40 years, roared back. Central banks slammed on the brakes, raising interest rates faster than ever before. Tom's portfolio didn't just stumble, it evaporated. The high-growth tech stocks he loved fell 70% to 80%. He lost in 1 year what took him 5 years to accumulate. But the worst part wasn't the money, it was the psychology. Tom panicked. He watched his retirement date drift 10 years into the future. He couldn't sleep. Every time he opened his brokerage app, he felt physical pain. So what did he do? He sold. He sold at the absolute bottom because the emotional pain was too great to bear. Now let's consider Sarah. Sarah is an architect. She understands structure. She knows that you don't build a skyscraper assuming no earthquakes will happen, you build it to withstand them. Sarah adopted the all-weather philosophy. She understood that different assets perform well in different seasons. When growth is rising, stocks and real estate shine. When growth is falling, government bonds protect you. When inflation is rising, commodities and gold are your best friends. When inflation is falling, long-term bonds act as a powerful engine. Sarah didn't try to predict the weather, she prepared for all of it. However, Sarah knew that the traditional all-weather model needed an update. The classic model, often associated with Ray Dalio, relied heavily on long-term bonds to offset stock losses. But recently we learned a hard lesson. Sometimes, stocks and bonds fall together. The correlation turned positive. The brakes failed at the same time the engine stalled. So Sarah constructed the all-weather 2. This modern version has 4 distinct pillars, designed to handle even the most chaotic environments. Let's break down these 4 pillars in detail. The first pillar, the growth engine. This makes up about 30% to 40% of the portfolio. This is your global stock market exposure. US stocks, European giants, emerging markets. You need this because, over very long periods, humans innovate, economies expand, and companies generate profits. This pillar thrives in the rising growth season, but note that Sarah didn't just buy the S&P 500. She diversified globally because there have been decades, like the 2000s, where US stocks returned exactly 0%. By going global, she reduced that risk. The second pillar, the deflation shield. This is your safe haven. It consists of long-term treasury bonds. Now, I know what you are thinking. Daniel, bonds are boring and they lost money recently. Yes, they did. But historically, when the world enters a deep, dark depression or a deflationary crash, think of the 2008 financial crisis or the Great Depression of 1929, investors panic. They run to the safest asset on earth, US government debt. In those doomsday scenarios, while stocks can fall 50%, these bonds can rise 20% or 30%, offsetting your losses. They are the airbag in your car. You hoped you never need them, but you are incredibly glad they are there when you hit a wall. The third pillar, the inflation shield. This is the component Tom completely ignored. This bucket holds gold and a broad basket of commodities, energy, agriculture, industrial metals. Why is this crucial? Because when inflation spikes, the price of stuff goes up. If you own the stuff, your portfolio value rises. Gold is particularly special. It is the timeless currency. When people lose faith in paper money, or when governments print too much cash, gold acts as the ultimate store of value. In the 1970s, known as the era of stagflation, stocks were dead money for over 10 years. But gold, it went through the roof. This pillar protects your purchasing power when the currency is under attack. The fourth pillar, the modern stabilizer. This is the upgrade for version 2. This pillar consists of liquidity, cash, and alternatives. In the old days of zero interest rates, the saying was cash is trash. But today, cash is a strategic weapon. Short-term treasury bills or money market funds pay you a decent yield just to sit on the sidelines. But it's more than just yield. Cash gives you optionality. When the markets crash and everyone else is forced to sell to pay bills, having cash allows you to step in and buy assets at a discount. It is the oxygen tank that lets you breathe when everyone else is drowning. So how did this play out for Sarah during the crisis? When the inflation storm hit, her stocks took a hit just like Tom's. Her long-term bonds also suffered as rates rose, but her commodities and gold surged. They skyrocketed as the cost of living went up, and her cash position acted as a buffer, dampening the volatility and earning interest. While Tom was down 50%, Sarah might have been down 5% or 8%, or maybe she broke even. This brings us to the concept of the lost decade. Many young investors today have only seen markets go up. They don't remember the period from 2000 to 2013. If you had invested $10,000 in the S&P 500 in the year 2000, 13 years later, you would have had roughly the same amount, 13 years of waiting, with 2 massive crashes in between. An all-weather portfolio, however, would have made money during that time. Why? Because while stocks flatlined, bonds rallied, and gold had a historic bull run. This is why you diversify. You diversify to avoid wasting a decade of your life waiting to break even. Now I want to talk about the hardest part of this strategy. It is not the math. It is not the ETF selection. It is the psychology of rebalancing. The all-weather portfolio has a fatal flaw. It is never the best performing portfolio in any single year. In a roaring bull market, your friends will brag about their 50% returns while you are making 10%. You will feel FOMO, fear of missing out. You will feel stupid. You will want to abandon the strategy and chase the hot stocks. But here is the secret sauce. You must rebalance. Once a year, you look at your pillars. Maybe stocks went up a lot and gold went down. You sell some of the expensive stocks, which feels painful because they are winning, and you buy more of the cheap gold, which feels scary because it is losing. This forces you to do the one thing that is unnatural for humans: buy low and sell high. Most people buy high because it feels good and sell low because it hurts. Rebalancing automates the discipline. It forces you to be a contrarian. Let's return to our ship captain analogy one last time. Tom is sailing a speedboat. It's fast, it's sleek, and in calm waters he leaves everyone behind. But when the waves get to 20 feet, his speedboat flips over. He doesn't finish the race. Sarah is sailing a giant aircraft carrier. It's heavy, it doesn't turn quickly, it's not the fastest boat on the water. But when the 20-foot waves come, the aircraft carrier barely moves. She cuts through the storm. She keeps moving forward, slowly and steadily, while the speedboats are sinking around her. The goal of the all-weather portfolio, too, is to keep you in the game. It is about survival. Einstein called compounding the eighth wonder of the world, but compounding only works if you don't interrupt it. A 50% loss interrupts compounding. A total panic sale interrupts compounding. This strategy is the insurance policy for your compounding machine. So what have we really learned today? We learned that arrogance is the enemy of wealth. The moment you think you know the future, the market will humble you. The all-weather approach is an admission that we don't know what happens next, and that is okay. We learned that true safety doesn't come from picking the right stock. It comes from picking the right asset classes that balance each other out. It comes from owning things that hate each other, so that when one falls, the other stands tall. And finally, we learned that the best portfolio isn't the one with the highest theoretical return on a spreadsheet. It is the one that lets you sleep at night. It is the one that prevents you from panic selling at the bottom. Because in the end, the winner isn't the one who ran the fastest in the first mile. It's the one who is still standing at the finish line. We are living in a time of regime change. The easy days are likely over. You can choose to be like Tom, chasing the last war and hoping for the best. Or you can be like Sarah, building a fortress that can withstand any storm. Building wealth is not about how much you make. It is about how much you keep. Thank you for spending this time with me on MonsterInvest. If you found value in this deep dive, please do me a huge favor. Smash that like button, hit subscribe, and ring the notification bell so you never miss a future episode. It helps the channel grow and allows us to bring you more content like this. I'm Daniel. Stay safe, stay diversified, and I will see you in the next episode.